Hey, good afternoon, everybody. Chris Lester here. Before we get started, first I want to welcome everybody for taking time out of your day to listen to our weekly chat. And we just want to stay connected with, not only our clients, but we have advisors on the call who are inviting their clients. And it's just a very neutral educational space where we can share some of my thoughts and things that I see going on. So without further ado, today we're going to talk about what's happening with the market recovery. I like to start off of our meetings with some good news. And right now in the marketplace, we've had the jobs report 2.5 million increase in jobs in May, which was unexpected, caused a market rally and good news. Now, interesting enough is that, and it's not really surprising, but as states started to open up and people started to get back to work, 1.25 million of those were in the hospitality industry. So people getting back to the restaurant industry and things of that nature are causing the numbers to increase. So that was good news. June should be even better, right? As more and more states start to open up, you're going to see more and more people getting back to work, which is what we need for the economy to keep going. Some more good news. The curve is flattening. There have been some spikes of late with some of the protests that have been going on across the country. I think a lot of people got out there early. Some states, Texas, maybe even Florida. I think Nevada saw an increase as casinos opened. We're not out of the woods yet, but I think the spikes were to be expected. But overall, it's not nearly as taxing as when it first came out and there was pure panic. So again, most states have opened back up. I know New York, here in New Jersey, I'd say we're getting back there. Even there's still restrictions in place. I just heard now that California is saying any public type venue, they're trying to mandate that you have to wear a mask. I get out a little bit, the nice weather, whether I'm doing yard work, honey-do list. I'm watching the public and just what are my senses telling me. And you have varying degrees of people that are taking COVID-19 serious. We have to all do our part. We all have extended family, and there's still a lot that remains to be seen. But as we get through this, I think we will be better prepared for next time. So this has forced us to start to look more closely to how we handle viruses going forward. Portions of the U.S. stock market are close to full recovery. Again, 2 out of the 3 indexes that we follow are up today. NASDAQ, if not at, pretty close within a few points of all-time highs. So as far as the U.S. stock markets are close to full recovery, I think that you'll see here in a few slides that you have to be careful as how perception of what the media is having us believe. From good old Uncle Warren, I've shown these slides, some of his comments in the past. Some interesting tidbits. If you don't follow Warren, he's probably the greatest investor of our time. I mean, since 1976, he has averaged just about 21% on his portfolios and how he manages investing compared to the S&P, right? He has literally doubled the S&P over his lifetime and experience. And he's even given the opportunity to invest in his philosophy by buying Berkshire Hathaway stocks. So if you wanted to say, hey, I want to be like Warren Buffett, you could buy his stocks. And the reason I say that is because Warren Buffett right now is down 15% right now, where the market's almost flat. He's down 15%. So I think it's just important to put things in perspective. The greatest investor of our time in a market recovery is down, right? And that is because he's very, very disciplined in what he's going to do, when he's going to enter the market. And it's not his first time through this. So just be careful following advice, how you get into and out of the market or try and time the market. Because again, one of the greatest investors of our lifetime is down. So when you see the market rallying and you go, okay, everything's great, we have to understand why. And one of the slides that we've been showing lately is this one here. This shows three indicators of the S&P 500. And for those of you that are not aware, one of the things I want to make sure you understand is that the S&P index is a market-weighted index. So meaning that some of the top holdings of certain stocks make up a large portion of the index itself. So, the three indicators here, you have the RSI, Relative Strength Index is the top one. You have the middle, which is moving averages. And then you have the MACD, Divergence Indicator. And this is not how we necessarily believe you invest, but it's part of when we're monitoring what's going on out there. There's some observations, and I like to share some of what's going on because there's been some unique things going on. And the first thing I wanted to point out to you, it's a little hard to see here, but what has to happen, if you see going, top to bottom vertically, if you see red lines, you see green lines. So red means that three of the indicators have turned negative, right? And if that happens, you typically are going to have a downward market, a recessionary type environment. On the contrary, green means that the three indicators have turned green or positive, and we should start to be on a recovery. So one of the things I want to tell you, this is going back, this is updated every month. It's going back for the last 20 years. It's a macro view of the S&P. And the one thing that has never happened before, if you look at this number here, this negative 13%, right, in the right-hand corner, this is showing that since this green indicator, these three positives, that we have a negative turn, and that's because of COVID-19. And had you followed this indicator, if this was your investment philosophy, if when this says to sell, you get out, when you get in, you get in, you could have missed out on this market recovery, right? This was a head fake. And, so it's impossible to predict the markets. And part of what I'm just trying to help you to understand is that this model right here, this S&P, if you had been in this market for the last 20 years, is up 115%. Had you followed this philosophy, right, where if the market three indicators went down, the overall performance would have been about 176%. Now, again, this is not saying it's right or it's wrong. It's just saying that there were head fakes in here, that there were times when the indicator said, hey, get out, and it would have been at the wrong time, just like COVID-19 said they get out at the bottom of March. And when a lot of people were thinking, oh my God, the sky is falling, right, that let's move to cash, you would have made a small error in judgment. And this is where being patient and having plans in place and having advisors that understand, like Warren Buffett, that you have to be in it for the long haul, right, over time. But here's something I think that also needs to be brought to your attention, that the S&P, a lot of people are under the impression that the S&P, 500 stocks, you're diversified, that's the market. But the top 10 holdings of the S&P 500, let's look at some of these, right? You got Microsoft, Apple, Amazon, Google, Facebook, right? The top 10 stocks here make up a quarter, 25% of the S&P value. So you look at this and you go, this is where, I emphasize, if you're not familiar with the term, market weighted cap or market cap weighted. What this means is that if one stock is more expensive, it will hold a proportionately larger portion of the index. Now, as I mentioned, the NASDAQ is at all-time highs. If it's not there today, it's pretty close. And let's look at the top 5 stocks of the tech sector. Both indexes are predominantly being led by these tech sectors, Apple, Microsoft, Amazon, Google, Facebook. This makes up almost 50% of the index. Now, if you'll notice that within the two indexes, same holdings. So there's the old adage of all your eggs in one basket could lead to some issues. And part of what I try and share is that when we're looking at charts like this, part of a recovery, people are like, well, Chris, your presentation this week, are we on route to a market recovery? And the answer is undoubtedly yes. The markets over time will go up. The question is a matter of when. Quite often what's happened in the past in history is before markets can go up, they have to test the bottoms. So I would say that the S&P testing a reduction of 10% and then bouncing past that. So it's called higher lows and higher highs. So each sequential low is just as it's trying to bounce like a ball upwards. If it doesn't break through that floor, would be a good sign. But I do caution that the media would have you believe that, hey, everything's great because look at the S&P, look at these indexes, where when you look on the, just you peel back the surface a little bit and you see that it's being led by some very significant companies that we're familiar with. But part of what I try and share with clients is that companies that are leaders today are not going to be leaders 10 years from now. Companies that were leaders 50 years from now are some of them not even in business anymore. As a matter of fact, companies 10 years ago may not be in business anymore. So as we're looking and we start to think about diversification and having strategies and trying to time the market, that's where just if you're going to be a buy and hold passive investor, be in the market, you got to give it a decade. But if you're going to use a little bit of dynamic allocation or a tactical approach, then you can use a little bit more sector rotation or planning like that. But my point is don't necessarily believe that you think that being in an index like the S&P that you're diversified. There's more to it. So this is a chart that we use, and I like it because what it does is it strips away all the noise. This is just data. When you look at right now, since the beginning of the year, the last 5 months, you look at U.S. large companies, the return, that we're really just off the highs, 2, 3, 3.5% maybe. But as you go down the list, now let's say the Warren Buffett philosophy, large value stocks, well, he's down 15%. That's, since the beginning of the year. So the numbers to the left side of the column, right, the red numbers, U.S. small caps, 14, small caps. Everything other than large caps, before you get into the fixed income, are down anywhere from 15 to 20%. That's the rest of the world is down 15 to 20%, U.S. included. But if you go to the right a little bit, what I want you to see is that U.S. large companies over the last 90 years, so this is going back even pre-Great Depression timeframe. This is just data, that the worst performer over the last 90 years is U.S. large caps at 9.47 compared to diversification amongst some of the other asset classes or classifications or strategies. That being said, so if your portfolio is trying to get reasonable rates of return, just understand that the equities markets are being tested across all fronts, and the U.S. large companies are being led by 5 to 10 stocks. So just put it in perspective. Now, the bond market, you'll see, has been pretty flat comparatively. And actually, a large portion, a lot of the bond indexes, whether it's the AGG or the BND, which you would think would be a complete picture of how bonds are performing globally, are actually skewed because it's also market cap weighted. So you have predominantly 70% of the holdings of those indexes are U.S. Treasuries or U.S. note or T-bills, right? So any of the U.S. bond market is accounting for 70% of the fixed income index fund. So again, I just point this out to you so we keep it in perspective. Because as you look at a chart like this is really just saying the index, if you look at the top, it's 100. So this is similar to the models that we use from an allocation standpoint. So if you're 100% in the market in an index portfolio, and this makes sense, that you're down 16% in the last 5 months, which I think a lot of you would attest to. Yeah, that's about where my portfolio is now if you're 100% in the market. But if you start to go down and let's say you're like one of our accounts might be 60-40, 60% equities, 40% bonds, well, that might be down like 9%. And then as you get more and more conservative, you can see a little bit less. So when you're trying to get between 6 to 10% rate of return on your portfolio, you only have to understand that over time, over history, that we will get there and that you don't have to necessarily swing for the fences. So when you look to the column to the right, a 60-40 allocation of equities is averaged over the last 90 years about 8.58%. So the single greatest theme that I can stress to people that are on the call week in and week out, as you're watching the markets, as you're thinking about information that you're trying to digest, is be patient, right? This too shall pass. I've said that in the past, and that the markets, there's a lot of noise out there. And that if you have a strategy that we're trying to get reasonable rates of return, between 6-8%, I think is reasonable, depending on your risk tolerance, that over time we'll get there. So just be aware. So that brings me to the 4 most expensive words in the English language are, this time it's different. You know, Sir John Templeton, he was the founder of Franklin Templeton Funds. I mean, this is a fact. And guess what, folks? This time it is different. But so was it in the housing crisis in 2008. It was different then, too. It was different when the tech bubble burst in 2000, or when we had Black Monday, right? It was different then, too. Or oil embargoes back in the late 70s, early 80s. It was different then, too. And we could go on and on and on with examples. They are different. But we have to understand we can't time the market. And as much as you would say, well, let's just hop in and we'll follow this, it's just been proven time and time again that you end up leaving a lot of money on the table should you take that approach. So what happens next? Well, highly likely that we will have higher unemployment. Even though people are getting back to work, a lot of businesses are closing. Between last month, this month, and probably next month, 3.5 small businesses will close, right? So we've been through things like this before. We will get through this now, but you have to have plans in place, and you can't panic. So if something does happen, you lose your job, we'll get another job. You'll be able to pay your bills. But whether it affects you or not, it will affect your portfolio, so we have to keep that in mind. Most interest rate sensitive investments will struggle. I mean, we're down around 1% negative rates of return being offered by the banks have not happened yet, but could it? I don't know. Japan went through a 20-year period where that was the case. So we don't know, but if you were retired in the 90s and you needed 6 or 8 or 12% on your portfolio to be able to retire, you're in trouble now if you're in interest-bearing type holdings. And human behavior will change, at least temporarily. We're just going to adopt. We're going to adapt. We're going to do whatever we have to do to figure it out. But I just want to let you know that I'm always a phone call away. If you got questions, you want to talk, please pick up the phone, give me a call, shoot me an email. I'm really good at getting back to people. But I will tell you, the markets are going to go higher. We just don't know when. Don't panic, because Dalbar has done a study that we typically get out of the markets at the wrong time and into the markets at the wrong time. But if you have a strategy overall on how to create a reasonable rates of return, you'll be better off in the end. So the last Warren Buffett nugget is, no matter how great the talent or effort, some things take time. You can't produce a baby in 1 month by getting 9 women pregnant. Even Warren Buffett's got a sense of humor. So without any further ado, that's her disclosure. All right, guys. I want to thank everybody. See you same time next week. Thank everybody for being on the call today, and have a great day.